Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities, and your macro updates. My name is Ryan.
And my name is Lucas. And speaking of macro updates, we've got some exciting economic news to share. Of course, we love to talk about the economic outlook, not just the crypto markets, because they're all connected. There's a strong correlation, and we'll go into more detail as to why. But right now, the big news all over is inflation, the inflation data that came out, and how the stock market, the traditional market, and the crypto markets have all sold off and dumped. We've been talking about this for a while. This is kind of what we like to talk about. So if you do like understanding about the mechanics behind the scenes as to what caused these market dumps and what to expect in the future, then give us that love, support, subscribe, notification bell, because we will continue to keep you abreast of the latest developments and how you can be better prepared for what's to come next. But to understand what's to come next, let's talk about what's happening right now. What was the inflation data? Why did the market react the way it did? And what is going to come around the corner?
That's right. Well, we just got data for the month of August on what the consumer price index is saying about inflation. And while we've seen some pretty significant reductions in fuel costs that have really been well needed, and we're all happy to see, there's been some bad news on other aspects of inflation. Rent, housing costs is a big one. Rents are up. Food is at a large high, like I think since the 70s, it's a high. Healthcare costs keep going up, and core CPI, which is a measure of inflation that excludes the volatile categories of food and energy, is still, even if excluding those things, is still surging and growing, increasing. So not the kind of thing you wanted to see. It's moving in the opposite direction from what the recent trend has been for a little bit of easing in the inflationary pressures. So we're seeing things moving in the wrong direction versus last month. So what that basically means is that the chance or the likelihood of another 75 basis point rate hike from the Fed in September is all but assured. Potentially, even opens the door to even bigger 1% rate hike. I'm not saying that's what I predict, but that it's more on the table than it was before. And yeah, that's the big story here.
And I'm glad you mentioned food prices because I'm not sure if it's in this article or another one we had up.
It
Oh,
is.
there it
It's right
is.
here.
So, I mean, food prices in the last 12 months, in the last year, they've gone up more over 10%, 11.4%. This is the largest increase in food prices since 1979. And like you mentioned, these a lot of these prices, these metrics, they're not even in the CPI. A lot of these food prices, energy prices, because of they're taken out, and yet there's still inflation going on in these sectors. And when
Right.
you look at food prices surging, I mean, for many people, this is one of the largest expenditures in their monthly income. So a 10%, 11% surge in food prices. Now, does it look like food prices are going to go down anytime soon? Not at all. It looks like food prices are probably going to continue to surge moving forward. When we look at supply chain issues that we've talked about and we'll continue to talk about, but they exist, whether it's from the pandemic or from the war. And of course, you look at the inflation, and we'll get into the sticky prices, but a lot of the money printing and a lot of the inflation that's taken place is still yet to trickle down, and we've still yet to see it play out into all of the physical prices that we interact with. So this is just the beginning.
Right.
You mentioned a full percentage point, 100 basis points, that being on the table. It almost seems more likely that the market would expect from these inflation numbers that the Fed's most likely going to do their aggressive stance, which is more than 70. I almost feel like that is almost being
It's
priced
almost
in.
called for. Yeah, it's almost like they're calling for that, right? Or that the Times, almost call for that now. With what we're doing now is not working, clearly.
Okay, now that I mentioned priced in, so if you're new to the channel or following along with us, so we mentioned this a lot. It's just one of the phenomena in markets. why is the market dumping now based upon something that hasn't happened yet? Well, it deals with expectations. And a lot of
Right.
times, the Fed's job is, and we talk about the nuanced language that is used, the jargon, the subtle words that can trigger sell-offs or other reactions in the market. And managing expectations is a big part of what
Yes.
is done through the news and through these announcements. And
And I
so
think
the
that's
mark,
actually real relevant to what we're about to say here, is in the fact that, expectations were that inflation was going to be dipping. In fact, the
mhm,
forecast was that the CPI would be dipping by 1/10%, and then it actually increased, right? So you're right in that this is kind of going against expectations this day, and that's kind of why I think the market reacted the way it did, right? You saw this big
right.
sell off, and we're going to get into the charts showing what it looked like, but massive sell off. And I think a lot of it was driven by the fact that we had some pretty decent news on inflation in the last month that sowed this kind of this assumption or expectation that maybe August would continue that downward trend of easing inflation pressures, and it didn't, and it actually shot up. And so it kind of it surprised everybody, went against what maybe the consensus was, and so it created this larger than expected reaction. So I think you're right to point your finger on expectations as being, a big part of the story here.
Absolutely. And you're right too, because that was a shock to the expectations. We're talking about the Fed having made a lot of aggressive decisions already with consistent rate hikes, and the markets
Right.
continued to price in these rate hikes and expect more rate hikes. But even with all of the action that the Fed has taken to curb inflation, it's still kind of out of control, you could say,
Yeah.
at the
I
moment.
mean, look at this, excluding those volatile components of food and energy, right? When you exclude those, you get what's called core CPI. So you're looking at core CPI, even that rose 0.6 in August after advancing only 0.3 in July. So, and there was an expectation that this would be increasing only 0.3%, like mirroring kind of what July looked like. And instead it doubled that at 0.6. So, and that's excluding the volatile food and energy. And we know food is one of the more, inflationary components to the CPI. So you stripping those out, you're still getting much greater than expected increase. So yeah, I think all in all, not the greatest numbers for people who are betting on the Fed pivoting, right? If that was your hope, then this is definitely dashing. And then you look at rent as well, up 0.7. This is month to month. This is not a year, obviously not a yearly increase. This is just over since July. If you're confused about that as you're watching us. So yeah, all in all, I mean, looking at pretty out of control inflation. Healthcare, another one. Services, hospital services, healthcare, prescription drugs, all pushing CPI higher. And we have another article, or this is actually the CPI itself, the summary itself. We'll link this below. This is from the BLS. You can look at the data yourself and see exactly which components are moving up and which ones are not, and what the change month to month looks like. But all in all, we're looking at an 8.3% inflation for August, which is that's year over year. So August of 21 to August of 22, you're up 8%. And I think it should be mentioned that, there was a long time, I think over a decade, where the Fed tried to get inflation just to be at a 2% target. 2 to 3% was like its target. And, and now we've had it over 8 for over 6 months. So, I mean, clearly this is not what they intend. This is not, and they want to get this number back down to what their target is, and quickly. The only question is well, how much policy contraction? How high will rates have to go? How much of the balance sheet will they have to sell off in order to achieve their goals? And then what's that going to mean for the economy at large? Those are the big questions.
Well, and we've talked about these questions, and we'll continue to talk about these questions. It seems if you read the tea leaves or you read the writing on the wall, and you just listen to their announcements, we're looking at another over a year of raising rates and selling off
Yeah.
the balance sheet. So, for any expectation that, oh, look at the latest dump, we must be at the bottom now. Quick, put everything in and buy now. It's always good to none of this is financial advice. None of this is investment advice, commercial advice, legal advice. It's educational, entertainment, sharing our research and perspectives to help you, if it can, make better decisions and have a better understanding. Because when we're ignorant of what's going on in the markets, there tends to be a lot of fear with
Right.
unknowns. But the more you look at something and understand, then you can remove yourself from that fear and just be patient and let these processes take place, like the ebb and flow of the market, and you can be better prepared for when the bull market does return. And
Yeah.
right now, we're looking for another at least a year plus, year to 2 years of correction. And as you mentioned, the balance sheet sell off, that has nothing to do with raising the rates so aggressively. That's another tactic that's being done
Right.
that will definitely affect the interest rates and the market. So
Well, before
there,
we hop into let's look at, I was going to say, let's look at some of these markets directly and see how they responded to this news. But before we
Mhm.
do that, let's just make it clear that why markets are responding is because they're looking at the Fed, how the Fed's going to react to this inflation data and what that means for prices going forward. And obviously you want to buy something cheap and sell it high. And if the market expects the Fed to start raising rates and or not start, but to continue, not to stop, to be more specific, not to stop raising rates, not to pivot from that anytime soon, then those prices they're going to pay today are probably potentially at a peak because financial markets discount future flows of revenue and they use interest rates to do that. And the higher interest rates go, the higher that discount goes, which means that the further you raise rates, the lower the present prices become for stocks and securities because those discounts on those future revenues are getting greater. So you're discounting that future $100 more and more and more with every increase in the interest rate, which means that the present value, the present price comes down. So that's why market participants are looking to the Fed and why they're so cautious to not be buying the dip, like because like you suggested, when you see markets react and sell off, a common response would be to go in and buy the dip, buy the fear, right? Trade the fear and take a position because you expect it to retrace and go back towards some kind of an average or a fair price. But the structural or fundamental question is, well, what is the Fed doing? What are interest rates going to be in the next year or two? And if and we already explained what that means. So that's just to kind of draw a real easy picture of what markets are doing here, why they're selling off.
and make no mistake, we'll continue to talk about this. Our passion is economics and looking at the macro picture and where blockchain and crypto fits into that as a new technology, new development is very exciting, and we'd love to share that, and we'll continue to share that. And if you're new to blockchain or crypto, it's a great time to start. It's never a bad time to learn or to get involved.
Right.
We learned our lessons from getting lazy on the research during the doldrums of the last market crash after the ICO 2017 craze. And the reality is, it's a great time to see those projects, to do your research, and to find out which crypto communities are developing, are building decentralized applications that are going to add value. And
That's right.
so it doesn't mean walk away from the market for a year or 2 years, because no, this is a great time to do your due diligence. And if it's like tuition or the cost of a class, I say if you go in for learning, then the best way to learn is to get involved and support blockchain crypto communities, whether or not the price goes up or down in the short run. If they're going to be around for a while, there's a good chance that you can benefit
Yes.
from that, as
Regardless.
well as
Yeah.
other opportunities in the long run. So that's why None of this is trading investment
Right.
advice. It's more of a macro fundamental look at where to find long-term value,
Where to
and
look.
where to look, and where are these prices, what value are the prices reflecting. Hey, this video is running a little long. I hope you're loving the economic macro update. We've got some more news to share with you. So if you like what you're hearing and you want to hear more details, check out part 2.